Buying individual stocks, is it a good idea, a bad idea, or somewhere in between? Let's talk about that today. Hey, I'm Tim Kiser. Welcome to the Profit Dare. On this channel, we provide simple financial solutions that inspire savvy stewardship. If this is your first time stopping by, thank you so much. And if you have been here before and decided to give it a second chance, thank you for coming back. And if you are a subscriber, blessings to you. Thank you. We really appreciate your partnership. So the question is, buying or investing in individual stocks a good idea, a bad idea, or somewhere in between? One of the most popular financial talking heads on YouTube and the radio and everything else says it's a terrible idea to do this. And as much as I like to disagree with people, he's probably right in this situation for most people. Individual stocks can be risky. From a Christian perspective, we have a great scripture in Ecclesiastes that talks about giving 7 or 8 shares or invest your venture in 7 or 8 because you really don't know what bad thing is going to happen. I'm sure I am absolutely massacring that verse, but I'll put it up so you get the right deal. But it's kind of like we have different areas of our life. We don't really know. And it's kind of funny. The stock market's trippy because we like to think that we know what we're doing, investing in individual stocks. But often the market just kind of goes together. I mean, you might have some outliers, but the truth is most of us don't have the necessary time or intelligence, I hate to say that, to actually evaluate stocks properly. So we're better off, in most situations, better off sticking with mutual funds or exchange traded funds. I do both of those, and I also do invest in individual stocks. And I would never, recommend you do something I don't do, and it's fun. There's a lot of things, people say you shouldn't do it, it's risky. You shouldn't eat bad food, you do it anyways. You probably shouldn't play the lottery, but you do it anyways. You probably shouldn't drink alcohol all the time, but you do it anyways. There's a lot of things we shouldn't do, but we do. And I would say investing in stocks can be fun. It can be exhilarating. It can be, now if you have a gambling problem and it's a gamble, I would think you probably shouldn't do it. But most likely it's just kind of like you want to challenge yourself to see, is it possible I might be able to pick a winner here? Now, honestly, let's be brutally honest, most likely you can't. I doubt Warren Buffett's watching this channel. He's about the only one. Him and Charlie Munger do a really good job of screening stocks, but they have a system and they have billions of dollars to work with, and they actually just buy whole companies too. But if you don't have the time to do it or the actual academic background, I would recommend sticking with mutual funds and exchange traded funds. Now, here are the criteria I use for investing in stocks, and it's really not. I'm not looking to pick a winner because I understand I don't know what I don't know. I don't have a crystal ball, and I'm just doing the best I can. But I'm picking stocks for one reason, and that's for dividend growth. Now, in most of my mutual funds or exchange traded funds, the dividend gets diluted because they'll put in something like one that pays like a dividend yield of 0.5 and one that pays 0.3, and they kind of get blended. And most of my dividend yields are lower than what I'm making on a savings account. And a dividend is basically it's the profits the company shares with the investor. So if you own stock in, say, ExxonMobil, and they make a profit, they give you a dividend share, and you can use it as cash. You can get it as cash as income, or you can get it and just reinvest it in the company. I personally reinvest all my dividends, at least right now. I'm still kind of young. I'm not 60 yet. So here are the things. So if you do not have a financial background, I would say stick with mutual funds and exchange traded funds. I do. I've been in commercial finance for over 2 decades. I have a ton of experience analyzing financial statements of small, medium, and large companies. So I'm not saying I'm brilliant at it, but some of it makes sense to me, and I can go through it and sift through things. So me picking up a 10K from a company, I can go through the financial statements, throw something in a spreadsheet, and boom, pop out some stuff. Or I can use a stock screener and do the same thing. And here are the criteria I use. Now again, I'm not trying to pick winners because I know I can't. I just do not have that kind of brain power or foresight. But I do eliminate some people, I think, because you have to have a standard that you want. Because if you're just trading stocks based on what your friends tell you, you're going to lose your shirt every time. So here's the 7 I use. First one, and these are no particular order. This is ones I just wrote them down. Dividend yield has to be at least 3 and no more than 7, except for REITs, and we'll explain that in a second. So right now on my online high yield savings account, and it's an inflationary period, so if you're watching this later, but right now in 2023, I'm getting a 3.75% on a high yield savings account. That's risk free. Just money I'm not spending. That's my emergency fund, my sinking funds, and things of that nature. I'm making a pretty good chunk of change. It wasn't that long ago I was making like a half a point. So I want the yield to be high, but not too high. If it's too high, it means they're trying to track investors and kind of bribe them into buying the stock. So a dividend yield between 3 and 7 at this point. I probably should bump it up a bit now, but I do have some that are probably lower into that scale. A dividend payout ratio of less than 60%. And I'll do 60. I prefer less than 50. Dividend payout ratio is when a company pays a dividend. It's like the dividend to how much their earnings. It's the ratio of that. Why would I want that to be less than 60 or 50%? Because it costs money to run a business. And companies that continue to stay relevant must reinvent themselves all the time. They must have research and development, and they can't continue to pay all the profits to the shareholders. It just doesn't work that way. You want to pay something. I don't invest in companies. Some people do growth investing because they're looking for capital appreciation. They buy the stock for 10, it goes to 20, and then they sell it and they make $10 off of it. I get that. I love the growth aspect of that, but I'm looking for a dividend payout too. And so if they're not paying anything, I'm not investing. If they're paying less than 3%, I'm not investing. But I also don't want them paying so much they're burning their cash just to keep investors happy. So that's the second one. I'm just like, you start doing this and you start eliminating companies left and right. Again, you can pick your own. You just have some standards. Say, well, this is what works for me. Trust me, if someone says their thing works, unless their name is Warren and ends in Buffett, they don't know what they're talking about. They're just like us, just trying to figure it out step by step. Third one, current assets must be greater than long-term liabilities. I want to make sure that a company has enough inventory, receivables, and cash on hand to take care of all their debt. I don't like companies. I don't trust companies. I don't feel comfortable with companies who are constantly using leverage to make their company work better. I like companies, and sometimes a brand new stock you'd have to because they're starting out, but they're probably not paying a dividend, so I'm not going to invest in them anyways. And again, these are my standards. But I want to make sure they have enough there to cover that long-term debt. So they're operating a really tight ship and conservatively. So current assets must exceed long-term liabilities, all of them, current and long-term, the whole schmear. They must have increased their dividend payout for 5 straight years. I don't want to go into a company 1 year they're paying 3, next year's at 1, next year's 4, then 2. Dividend growth should be, if a company is focused on investors and their customers, they're going to bump that dividend up regularly. And it could just be a little bit, but a little bit's fine. It's a pay raise, right? I don't want to be in a company where they're all over the place, because that means their management probably is not doing a good job of driving their business. So I like companies to have at least 5 years of annual dividend growth. Now, some companies are going to have some blips. Right now, one of my stocks that I love is 3M, and we are invested in 3M, and they are having some difficulties right now with some lawsuits. I don't know what's going to happen with them. They're going to bump, if they're going to like decrease their dividend. And this is one, I think it's what you call a dividend aristocrat. They've been paying increased dividends for like decades, and they bumped into some trouble here. So we'll see how they navigate that. That my formula might be challenged if they like all of a sudden drop theirs. So do I sell then? I don't know. But I like when my initial investment must have 5 consecutive years of annual dividend growth. Next one, price to earning ratio in my world has to be less than 20. I've made one exception for this in the last round of investing, and that was I bought Starbucks, and I did it kind of in their price to earnings ratio is higher, and price to earnings is like, is the stock a good price? Is it on sale, or is it cost a lot? So the price to earnings is how much I'm willing to spend for $1 of that company's earnings. Traditionally, like the entire market is like price to earning ratio of 15 to 18. I like keeping mine below 20. But I love stocks that are even low. I have stocks that are like 5 or 6 or 10. I was looking at one of my favorites as Heartland Bank and Trust. And when I lived in Illinois, they were the ones who did my mortgages and refis. Love this bank. And just a really conservative, almost country, like farming bank. Really solid financially. And they went public, and we invested. They're paying a decent dividend. So Heartland Bank and Trust, their PE ratio is like 10 right now. So that's fantastic. So we're in good shape with Heartland Bank and Trust. Anyway, next one, the next criteria, number 6, is no ethical implications. Now the situation with 3M is more of a legal thing. They made a product, and I don't know exactly what's going on with it. But it's challenging, and companies of that size will have situations. I'm talking about scandals. Things of that nature. It's best just to stay away from them because things can go south really fast. You think Enron, think Global Crossings, think companies like that where things just, something is bad, something is rotten in the state of Denmark, and you really want to avoid those companies because you can, 1, the dividend can drop really fast, 2, you can lose all your money. So if there are ethical implications, because think about it, if a company is going through a scandal, they're probably going to raise their dividend to try to attract investors. They're probably going to the share price will be low, so like everything's on sale. But if they're like, something is not right, and sometimes you gotta, this is the hard part about investing in individual stocks, is you need to be willing to actually go through the annual report, the 10Ks, and read the notes and read all kinds of stuff in there, because things can be legal but not necessarily ethical, and you want to make sure you're seeing something that's like, something's not right here. And if there's any tinge or a whiff of impropriety or unethical behavior, I would say run for the exit. And finally, the last one I use is they must be profitable for 5 straight years. You want companies who turn a profit, who are managed well. And if they're down for a year, just sorry. And it's like, you can make it really difficult on yourself to buy stocks by doing this. But also, you're also going to set a standard, and you're not going to be like influenced by like hype and the zeitgeist of the day. There's a lot of companies that come and go really fast, and they'd be really popular. Peloton a couple of years ago, but I was like, really, are people going to do this forever? And it worked well during COVID. But and there's companies like that all the time thinking, yeah, just let it go. I'd much rather stay with a company that's been around forever. Your AT&Ts, your Verizons, things like that pay a solid dividend, but they've navigated business cycles, recessions, liquidity crisis, and they're still standing. I'd much rather stick with companies like that and be that. But having said that, if you're unwilling to design standards, whatever they are, again, you pick yours. They just must be quantifiable and really helpful and material to what you're accomplishing. If you're not willing to do that, I would say stick with mutual funds, stick with exchange traded funds. I love my ETFs. I have through Fidelity, and I have some through Schwab. All of my mutual funds in my work 401k. I love index funds. They're inexpensive. I'm not a real big fan of buying mutual funds with 2%, 3% fees. I don't care what that one guy says. I mean, because then you're doing that plus inflation. You better be getting 13, 15%. And you're not going to, not in a safe manner. So I like index funds. I do a small cap, mid cap, large cap. I do international. I do some other stuff in there. I invest in mutual funds in my HSA, but in my Roth IRA, I do individual stocks. I have like 25, and I do two ETFs, and I do a REIT. And I said I'd mention that. So a REIT is a real estate investment trust. Now they actually pay super high dividends because they have to. I believe the rule is 80 to 90% of their income must be paid out in dividends every year. Because a real estate investment trust, they like invest in office buildings or apartments or whatever. And so the government requires them to actually pay out tons of money in cash. So I have two REITs. I think one got sold, so I'm going to flip that to something else because they're taking it private. But I believe the one REIT I had pays, I don't know, 7 or 8% dividend, which is super awesome. And it's not one that scares me because that's a law they have to have, right? So there you go. Here's my 2 cents nickel tour on should we invest in mutual fund or in individual stocks versus mutual funds. I say, yeah, do it. I would say I would wait till you have at least a really good solid foundation in other things, because here's the part with individual stocks. If you do it only that, you can have a lack of diversification that can hurt you. I think about all the people who lost everything in Enron, and I'm going to be brutally honest. We covered this when I was in grad school, getting my MBA, and I'm like, yeah, these people were just greedy. They were getting returns that were beyond the market, and no one said boo when it was happening. And then when it went crazy, like, oh my God, we lost our money. Who's going to protect us? It's ridiculous. So you can't expect to get 15, 20% every year, and like no one else is getting it. There's something wrong. And so, there's that. So you want to be diversified into several different categories, different kinds of stocks. Mutual funds, ETFs do it instantly. Also, if you're doing individual stocks outside of a tax-deferred plan like an IRA, I think the tax return process at the end of the year would be an absolute train wreck. I'm into simple financial solutions. I don't like messing with the IRS. I don't like making gains and then turn around and paying an enrolled agent or a tax attorney to figure it out because I made $84 on Starbucks stock and I had to pay taxes on it. I'd rather not. I mean, until you can max out your 401k, which is a ton of money, and if you can max out your Roth or your traditional IRA, depending on your financial situation, and at least put a super big chunk into your HSA, you probably shouldn't be messing with individual stocks. That's just my take. They are fun though, so it's fun to see how we did. Here's the hard part is when we do well, it's probably because the market did well. We probably wouldn't have done anything. We're not the next. Well, I'll just talk for me. I'm not the next Warren Buffett. If I was, I'd probably have known by now. So anyway, blessings to you, blessings to your family. I will see you soon with a new video. Thank you for joining me today. Hope this video has been a blessing to you. If it has, subscribe. Thank you for joining me today. If this video has been a blessing, please like, subscribe, share, comment, and I would like to read a blessing to you from the book, the good book. The Lord bless you and keep you. The Lord make his face shine on you and be gracious to you. And the Lord lift up his countenance on you and give you peace. I will see you soon with a new video.